Welcome to today's explainer. If you're a focused learner looking to completely demystify the mechanics of wealth building, you are in exactly the right place. Today, we're breaking down the blueprint for $1 million portfolio. Now, I know, for a lot of folks, just hearing that phrase, $1 million portfolio, it sounds totally out of reach, right? Like you need a massive Silicon Valley buyout or some huge inheritance. But the incredible truth we're going to unpack today is that building this level of wealth is absolutely attainable for ordinary people. It's all about applied mechanics, not luck.
So this brings us to a really fascinating question, one that pretty much everyone asks at some point. How exactly do ordinary people actually become millionaires? I mean, do they just earn absolutely huge salaries? Do they get incredibly lucky? Or is there a precise strategic blueprint that almost anyone can follow? We constantly look at self-made millionaires and just assume they have some secret advantage. But as you'll see, the path to building serious wealth doesn't require a winning lottery ticket. It requires a clear, actionable system.
Okay, let's dive into this. Here is our logical roadmap for today. We're going to start with the $1 million myth, then reveal the secret weapon of wealth creation, walk through the 8-step blueprint, analyze a sample portfolio, cover some common mistakes, and finish up with the power of time. Having a clear plan like this really helps take the anxiety out of the whole process.
Section 1. The $1 million myth. To a beginner, hearing the phrase $1 million often sounds completely impossible, but let's break that down. See, there's this massive disconnect between how society thinks wealth is built and how it actually happens. Society completely obsesses over the myth, right? Winning the lottery, finding the next Bitcoin, striking it rich overnight. It's that classic get-rich-quick fantasy. But the reality? Well, it's far more systematic and, honestly, a little boring. A staggering percentage of today's millionaires are literally just regular dual-income professionals. We're talking teachers, engineers, managers. They didn't invent the next big tech company. They simply used consistency, patience, and a deep understanding of time. The truth is, the earlier you start, the harder your money works for you. Which brings us directly to the core engine of that growth.
Section 2. The secret weapon. Let's transition into the underlying mechanics of how this wealth is actually generated over long periods of time.
So the absolutely crucial point here is understanding compound growth. The classic analogy is planting a single tree, waiting for it to drop seeds, and then watching those grow into an entire forest. But mechanically speaking, it's geometric progression in action. Your capital creates a yield, and that yield immediately becomes new capital. When your investments earn returns, those returns start earning their own returns too. Over decades, this creates incredible exponential growth. Great investors prioritize patience over speed, because small investments made consistently will very often mathematically outperform massive sporadic investments simply because of this sheer force of compounding. It's like a snowball rolling down a hill.
Section 3. The 8-step blueprint. Now, what's really interesting about this slide is how we pivot into a highly structured, step-by-step masterclass for building that wealth.
Step 1. You must earn more than you spend. Look, before you can even think about investing, you need one absolutely critical thing, and that is a surplus. It sounds painfully obvious, I know, but it's literally where 90% of people fail. You simply can't multiply a zero. If every dollar is spent, there is nothing left to multiply. You have to track your expenses, cut the fluff, and increase your income wherever possible to create that initial seed capital.
Moving right along to steps 2 and 3. Step 2 is building your emergency fund. Think of this not just as basic savings, but as a financial safety net, a firewall that prevents you from having to sell off your investments at the absolute worst time just to cover a medical bill or a sudden job loss. Then, step 3 is where the rubber meets the road. Invest consistently. People have this terrible tendency to wait for the perfect market, right? But successful investors don't do that. Nobody has a crystal ball. They deploy their capital regularly, totally regardless of whatever scary headlines are in the news. Consistency always beats perfection.
Okay, step 4 is diversify. We're talking about spreading your risk across broad market funds, international equities, bonds, and cash. Because putting all your money into just one company, that is incredibly dangerous. The goal here is strategic risk reduction. When one sector zigs, another zags. This smooths out your ride and protects you against catastrophic failures, all while still allowing for robust long-term growth.
Steps 5 and 6 are all about your psychological framework. Just look at this contrast, patience and discipline versus prediction and excitement. Amateurs crave the adrenaline rush of trying to predict the market, but professionals, they rely on the profitable boredom of patience and discipline. Markets will always experience corrections and crashes. But while fear and greed absolutely destroy the portfolios of novice investors, following a disciplined plan beats the excitement of emotional decisions every single time.
Finally, we hit steps 7 and 8. Step 7, reinvest absolutely everything. Dividends, interest, capital gains. Instead of spending them, roll them right back into the machine. This incredible snowball effect accelerates that compounding we talked about earlier. And step 8, increase your investments every single year. As your income grows, maybe through a raise or a new side hustle, bump up those monthly contributions. It dramatically speeds up your timeline to reaching that $1 million mark.
Section 4. Sample Portfolio. Let's transition into making this abstract concept of diversification incredibly tangible with a real-world breakdown.
And this brilliantly illustrates what spreading risk actually looks like in practice. You've got 60% in diversified domestic stocks, 20% in international investments, 10% in bonds, and 10% in cash or other defensive assets. Now, quick disclaimer, this is just an example, not direct financial advice. Your exact setup will heavily depend on your age and your specific goals. But this framework ensures you're positioned to capture global growth while simultaneously maintaining a really solid defensive buffer.
Section 5. Common mistakes. Let's pivot for a second to the emotional pitfalls and errors that completely destroy portfolios and delay financial success.
The absolute fastest way to derail your progress is letting emotion take the wheel. These are the costly mistakes that literally cost investors billions every single year. Trying to get rich overnight, chasing whatever social media hype is trending, it inevitably leads to taking excessive, undiversified risks. And when those backfire, people panic. They start constantly buying and selling, which just bleeds you out in taxes and fees. Plus, if you ignore your emergency fund and invest money you actually needed for short-term expenses, you're forced to sell at the bottom and lock in those losses. Avoid these trials at all costs.
Section 6. The Power of Time. Let's move to our final conceptual lesson, showing the true goal of investing and how momentum actually builds. Let's move to and see how this builds chronologically. This journey is a major test of your endurance. In Decade 1, I'm not going to lie, the math is barely visible. Progress feels agonizingly slow as you build that initial base, but you have to endure, because by Decade 2, a magical tipping point arrives. Your investment returns actually start earning more each year than you are contributing yourself. The math just takes over. And by Decade 3 and beyond, the heavy lifting is done. Your assets are generating true financial freedom, and your money is officially working harder than you do, scaling silently in the background while you sleep. Building $1 million portfolio is a matter of mechanics, discipline, and above all else, time. The biggest obstacle standing between you and that portfolio isn't a lack of massive capital, it's the cost of waiting. As the old saying goes, the best time to start was years ago. The second best time is today. So, I'll leave you with this. If you don't take action on this blueprint right now, what will your financial reality look like a decade from today?